Frank Engels is co-head of European economics with Barclays Capital, and he's in Frankfurt this afternoon. Welcome. Thank you very much indeed for joining us. Let's begin with this Spanish budget. I wanted to mention there were a couple of fiscal concessions to try and stimulate the housing market. It's very important that that happens, but how likely do you think these measures are to have much of an effect?
Well, obviously, if you have an inventory of a large inventory of unsold stock of houses, then it's clear that you could expect further price pressures, downward price pressures on residential property prices, and that obviously will restrain potential buyers from buying now, but rather possibly wait for a better market entry later. So clearly, what the government tries to do here is, with a fiscal incentive, with a tax incentive, to provide an incentive for potential buyers to come back to the market to clear that inventory of unsold new houses going forward. We do think on the current pace of purchases of those houses, it would take up to 4 years to clear that excess overhang. So clearly the measure is the right measure, but the potential for success is relatively limited. But still, obviously, the government ought to be commended for that measure, because it tries to tackle the issue at its source.
Now, we also saw concessions by the labour unions. It's very important for Spain to have got those, isn't it?
Yes, indeed. I mean, in the past, the government has already cut wages, has frozen pensions, and clearly it's a difficult time for everyone in the economy. And as you said earlier, the pharmaceutical spending cuts are just an indication that that tight belting is going forward. And it's important to see that the labor unions indicate to the government and to the officials more generally that they are prepared to share the burden in adjusting, in becoming more competitive through real wage constraints, and that obviously should help potential growth going forward over the medium term. It obviously will restrict consumption spending locally even further, and that will mean that the domestic recession we have in domestic industries in Spain as we speak will probably intensify going forward.
Now, you've written this report entitled "A Proposal to Restore Euro Area Stability." In it, as I said in the introduction, you say that either we have got more integration, both fiscal and economic, or there's a chance that one of the major countries will need a bailout. But you also say that it's going to take a very long time for something like Eurobonds to come through, and you've got an interim measure. Can you talk us through that?
Yes, I mean, the political reality is as such, and obviously also the legal reality in terms of treaties that ought to be changed, that you cannot quickly implement a true European fiscal union whereby you would issue Eurobonds and would have one sort of common fiscal policy that is centrally coordinated through, let's say, Brussels. So clearly this ought to be a medium-term perspective that Europe is hopefully moving towards. So in the intermediate period, you need to address what we think is a most pressing concern, namely the elevated marginal funding costs that the government faces in the government bond markets to issue new debt. To do so, and to credibly do so, we think it is required that you issue bonds that are credit enhanced through a European guarantee, sort of similar to what we are seeing already in terms of the EFSF bonds that are being issued, the European bonds that are issued to finance a European rescue mechanism to help countries such as Portugal and Ireland, but also Greece. So clearly a credit enhancement that would lower the marginal funding cost of, for instance, the Spanish government would be perceived very positive by investors, because it would lower the likelihood that public finances would be further under stress going forward.
Mr. Engels, we've just heard from Angela Merkel, and she has said that we don't want Eurobonds. In fact, she said that Europe would be worse off with a joint bond. What do you think of that?
Well, I mean, obviously there's this concern in let's say, what we call the core euro area countries, the AAA rated countries, that you don't have enough incentives that you can put on governments that have to adjust, like the Spanish government, like the Italian government going forward, in terms of fiscal and structural reforms needed. If you take away the funding pressure that these governments face in markets. So clearly, what you need to be doing is you need to complement a proposal of credit-enhanced bonds or even Eurobonds with an incentive structure that makes these countries safe and reform as needed. And that is why we propose that every country that has a fiscal deficit higher than what would be required to stabilize the debt to GDP ratio, and every country that has a higher debt stock to GDP than 85% would need to mandatorily submit itself into an EU IMF adjustment program to create exactly that type of incentive.
Mr. Engels, thank you very much indeed for joining us.